Recently, Goldman Sachs released a note stating that they believe the S&P 500 will deliver a real annual return of just 1% over the next 10 years. This is quite a pessimistic forecast. As you may have seen in recent news, this statement has sparked and renewed discussions about the idea of a lost decade in the stock market. This concept suggests that the United States could, in some ways, experience something similar to what Japan went through in the 1990s, a period of economic stagnation where the stock market essentially provides no real returns for investors. In this video, you'll find out if there's any truth behind these sensational headlines. Interestingly, we've seen notable investors like Ray Dalio and even the late Charlie Munger agree with the notion that stock market returns might not be very strong over the next 10 years. In this video, we'll analyze this hypothesis and explore whether it's a real possibility in the upcoming decade. A global survey by Natixis Investment Managers revealed that 67% of institutional investors believe that current stock valuations do not reflect economic fundamentals. Additionally, 75% of these investors believe that 2025 will be the year when markets recognize the importance of real valuations. This growing concern about the disconnect between stock prices and economic fundamentals has led major investors to reassess their strategies, aiming to protect their wealth in a scenario of potentially low stock market returns. As the name suggests, the idea of a lost decade refers to a 10-year period during which stock market investors see no growth in their wealth. For example, if you had invested in the S&P 500, which represents the 500 largest stocks in the United States, at the peak of the tech bubble, it would have taken until May 2007 for your brokerage account to simply break even. That amounts to 7 years of stagnation. And to make matters worse, after celebrating a 0% return over those 7 years, your patience would have been rewarded with the global financial crisis, which would take another 5 years for your investments to recover to zero. In total, this amounts to a 12.5-year period of stagnation, a true lost decade. What investors like the late Charlie Munger, Ray Dalio, Michael Burry, Jeremy Grantham, and others are warning about is that with the S&P 500 at incredibly high levels in 2024, and most U.S. companies showing signs of stretched valuations, there's a real chance that today's investors might be falling into the same trap, investing at all-time highs before entering a prolonged period of stock market weakness. Financial markets have been facing an increasingly evident disconnect between stock performance and economic fundamentals. Take the case of major tech companies in the United States, whose stocks rose an average of over 40% in 2023, despite a global economy still grappling with high inflation and rising interest rates. But what does this mean for you? Historically, periods of low or even negative returns in the stock market are not unprecedented. Between 2000 and 2010, the S&P 500 index delivered a cumulative return of just 0.4% when adjusted for inflation. This period, dubbed the lost decade, left many investors with stagnant portfolios while the cost of living continued to rise. If you think such a scenario is a thing of the past, think again. Economists are beginning to signal that we could be on the brink of a similar cycle. The reasons for this are numerous. First, there's the aggressive interest rate hikes by major central banks worldwide, aimed at curbing inflation but also making borrowing more expensive and slowing economic growth. Additionally, the global economy faces structural challenges such as an aging population in developed countries, rising public debt, and the energy transition, factors that could limit economic growth for decades. And why does this matter? Because, like a ship adrift, the stock market without strong fundamentals cannot sustain consistent returns. For everyday investors, this may not only mean low returns but also higher volatility, making it even harder to plan for a financial future. Let's break it down with an example. If you invest $1,000 per month in a portfolio that typically generates an average return of 7% per year, in 20 years you'd accumulate about $520,000. Now, reduce that return to just 2% per year. The result? Only $320,000. That's a $200,000 difference, enough to severely compromise your retirement or future plans. This type of scenario especially impacts those in the middle of planning for their future, like you. And don't be mistaken, the next decade won't make exceptions. If you're not prepared, you could end up sacrificing much more than you'd like. However, what sets top investors, such as institutional fund managers, apart from the average investor, is that they don't wait for the worst to happen before taking action. They observe market signals, analyze economic cycles, and most importantly, adapt their strategies. That's exactly what this video aims to teach: how to recognize the signs of an uncertain market, and more importantly, how to create a plan to protect your wealth while the rest of the market ignores the risks. To fully grasp the potential impact of a lost decade, we need to take a closer look at the behavior of top investors and how they're positioning themselves. Leave a comment below answering this question. What's your biggest concern about the financial market in the coming years? Let's see if you're right. In 2023, Warren Buffett surprised the market by holding over $147 billion in cash through Berkshire Hathaway. While many questioned why he wasn't investing aggressively, Buffett explained that he prefers to wait for clear opportunities rather than rushing into an overvalued market. During shareholder meetings, he reiterated his philosophy. Sometimes the best move is simply to wait. This approach reflects his view that, in times of uncertainty, having cash on hand allows investors to seize major opportunities, as he did during the 2008 financial crisis, when he purchased shares of solid companies at bargain prices. Ray Dalio, founder of the world's largest hedge fund, Bridgewater Associates, is another example of how to face volatile markets. In 2023, Dalio highlighted that his all-weather portfolio remains one of the most resilient strategies. It distributes assets among stocks, fixed income, commodities, and gold, ensuring protection against adverse scenarios. In practice, Dalio predicts a prolonged period of low returns due to high interest rates and global economic instability. He has recommended that regular investors adopt diversification as a way to safeguard their portfolios. As he often says, don't bet on just one horse. Make sure your portfolio is prepared for any weather. However, while Buffett and Dalio follow conservative approaches, Cathie Wood from ARK Invest has a bold vision. She is focused on disruptive technology companies like artificial intelligence and biotechnology, even in a high volatility environment. In 2024, despite criticism, her strategy yielded results in specific funds that benefited from the growth of AI. The contrast here is interesting. While investors like Buffett hold liquidity, Wood bets on innovation. This shows that strategies can vary, but all share a common denominator: planning and analysis. Diversification is much more than investing in various stocks. It is about distributing resources across different asset classes to reduce the overall risk of the portfolio. With rising interest rates in 2023 and 2024, many investors began migrating to fixed income, which offers more attractive returns than in previous years. Additionally, real estate funds and infrastructure investments have gained prominence. In the U.S., Treasury bonds became attractive again, with yields exceeding 4% annually, something unseen for decades. Another fundamental principle is maintaining the liquidity of your assets. Liquidity is the ability to respond quickly to market changes. In times of uncertainty, it not only protects against losses, but also allows for seizing unique opportunities. Warren Buffett demonstrated this during the 2008 crisis, when he used his liquidity to acquire shares of major companies at very low prices, generating significant returns in subsequent years. An investor who maintains a cash reserve can buy quality stocks during sharp declines, while others, lacking liquidity, are forced to sell at low prices. While top investors prepare, many small investors make mistakes that could be avoided, following the herd, buying at highs and selling at lows, neglecting long-term planning, focusing only on quick gains, underestimating diversification, becoming overly exposed to a single asset or sector. During the tech stock frenzy in 2021, many individual investors bought overvalued stocks. When the market corrected in 2022, these individuals suffered significant losses, while investors like Ray Dalio and Warren Buffett maintained balanced portfolios. Even without billions, you can implement these strategies. Start by understanding your financial goals and adjusting your asset allocation accordingly. Use accessible tools like diversified ETFs and fixed income funds. And remember, investing is like building a house. Without a solid foundation, everything collapses. As Warren Buffett says, you can't control the wind, but you can adjust the sails. Now that you understand the strategies used by top investors, it's time to apply them to your own context. It doesn't matter if you're just starting out or already have experience. The key to protecting your wealth during uncertain times is to act with planning and consistency. Your portfolio is like a garden. It requires constant maintenance. In a low-return scenario, this means assessing your investment allocation and making adjustments to safeguard your capital. Check if your portfolio is balanced between stocks, fixed income, and other assets. For example, if 70% of your portfolio is in stocks and markets are stagnating, consider increasing your exposure to fixed income. Use portfolio monitoring apps like Kinvo or Yub to track your allocation in real time. Imagine you have $100,000 invested, with 80% in stocks and 20% in government bonds. In a volatile year, your stocks lose 10% of their value, while the bonds yield 12%. Adjusting the proportion to 60% stocks and 40% bonds could have mitigated these losses and provided a more stable return. With rising interest rates in many countries, fixed income has become attractive again. These investments offer predictability and can help compensate for low stock returns. In Brazil, Treasury Direct bonds with daily liquidity are solid options. In 2024, a Treasury Direct bond offered returns of 13% annually, while the Ibovespa, the Brazilian stock index, experienced high volatility and much lower gains. Allocating part of your resources to such instruments would have ensured greater stability. In stagnant markets, patience is your best friend. Avoid making impulsive decisions based on temporary declines. Review your financial goals and resist the urge to adjust your portfolio out of fear of market fluctuations. Remember, time in the market is more important than trying to time the market. During the 2008 crisis, many investors sold at the bottom and missed the recovery that began in 2009. Those who stayed the course reaped the rewards of the economic rebound. Accepting that the coming years may bring lower returns is essential to avoid frustration. Instead of focusing solely on growth, concentrate on protecting what you've already achieved. For instance, rather than planning with a 10% annual return assumption, base your goals on 5% or less. These practical tips aren't just theoretical, they work because they're grounded in universal financial principles. Let's be honest, how many times have you seen someone in the financial market act like a genius, only to watch them fall apart during the first crisis? The truth is, the biggest mistake investors, big or small, make is believing they know more than the market. And you know what sets great investors apart? They don't try to be fortune tellers, they plan. Imagine this situation. You're in a casino. The stock market is the roulette table, and without understanding the rules, you put all your chips on the number eternal growth. Surprise! The roulette lands on volatility, and suddenly your account is in the red. At this moment, it's common to hear the phrase, "Oh, but the market always recovers." Yes, it recovers, eventually. But will you still be there when that happens? Or will you have already sold everything at a loss out of panic? Here's the point. While many are busy trying to look smart, great investors focus on being wise. They don't buy because everyone is buying. They don't sell because the market dropped today. They make decisions based on data, not emotions. And please stop thinking that being lucky is a strategy. If your financial planning involves hoping everything goes well, you're not investing. You're gambling. And unless you're extremely lucky, you're going to lose. The good news? You don't have to be Warren Buffett to adopt a smarter approach. What you need is to learn to stop, think, and act based on facts, not rumors. After all, as the saying goes, the market can remain irrational longer than you can remain solvent. Now that you understand the strategies of top investors and how to apply them to your own context, it's time to take action. Share this video with that friend who's always trying to predict the market. This might be the chance for them to learn that planning beats predictions. If this video helped you, subscribe to the channel. Good investments.